There is lots to consider when your mortgage comes up for renewal, and it can be a little bit overwhelming trying to figure out what to do. In today's video, I'm going to look at 5 key things that you need to think about when refixing your mortgage. By the end of this video, I'm hoping that you'll be well equipped to make a decision the next time that your loan comes up for renewal. As always, feel free to skip around the timestamps to save time. Make sure you stick around and watch till the end, as I do have a bonus tip that I'm sharing, which can help you potentially pay off your loan faster and save you some money in interest costs. So let's get into it. The first key thing to consider is, what is the forecast for interest rates? What does the market think interest rates will do? Perhaps more importantly, what is your risk tolerance? And how financially secure are you? Locking in rates for a long time mitigates the risk of rates rising higher, but also stops you from benefiting if rates do decrease as well. You may prefer to lock in a rate now and have higher financial security for the next few years or so. Or perhaps you like to take more risk and prefer to lock in for a shorter period of time. Or maybe you'd even like to go with a floating rate on the chance that maybe interest rates are gonna decline soon. It's about finding the balance that is right for you and meets your risk tolerance. The second key thing to think about when your interest rate is coming up for renewal is taking a look at your overall mortgage structure and reviewing, is the current mortgage structure actually right for you? Life changes as time goes on and our circumstances change as well. Sometimes what you initially started out with in terms of your mortgage structure does not meet your requirements today. Perhaps you've recently changed jobs and now get regular bonuses, which you can use to make lump sum payments against your mortgage. So potentially now, instead of having everything fixed on different terms, maybe a floating portion or even a revolving credit may suit your situation better. Maybe when you initially set up your loan, you had it all in one big portion fixed, but now you potentially want to split it up into smaller portions and fix it over different terms. Or maybe potentially on the flip side of that, you've had everything in lots of small portions and maybe you want to do a little bit of consolidation into just a few portions now. Maybe you've got some planned renovations coming up and you could potentially benefit from having a revolving credit facility set up. Or maybe you've been gifted a large sum of cash and potentially want to offset this against your mortgage. Whatever your situation, it's important that you discuss all these little things with your mortgage advisor when your loan is up for renewal, to see if the current loan structure is still relevant or whether changing the loan structure may be more suitable for your future goals and your current financial position today. The next key thing to think about is, when are your other portions of your loan coming up for renewal? If you have your lending split across different terms and different portions, it is always good and recommended to keep these split so you don't have everything rolling off at the same time for renewal. Unless this suits your situation, which will be coming up in point 4, so stay tuned. In general, it is always good and recommended to keep your loan split across different loan terms to mitigate the risk of changing interest rates and reduce payment shock. So the point here is, when renewing, make sure you review your overall loan structure and review when all your different portions are coming up for renewal before making a decision on which rate to lock in for the portion that is up for renewal. The fourth thing to consider is, are you likely to sell your house in the near future? If you sell your house during a fixed rate period, then you may have to pay a break fee to the bank. This is because when you fix a rate with the bank, you're promising the bank that you're going to pay them interest for the period of the fixed rate. The break fee buys you out of that obligation. So do keep break fees in mind when deciding whether to fix an interest rate and how long for. A way around this is to let your mortgage roll onto a floating rate, but only do this if you are planning to sell and the plans are definite for the next 3 months. Otherwise, you might want to consider locking in a rate for, say, 6 months. If your plans change and you're no longer looking to sell and you are on a floating rate, the beauty is that you can opt to fix it at any time. If you want to know what your break fees may be, the best way to find this out is by contacting your bank and asking them. Break fees are usually only valid for 1 day only. This is because the pricing calculations that the bank uses are based on current numbers only, so the fees can change on a daily basis. You can use the quote from the bank to estimate approximate break fees, but don't expect the numbers to be exact. The last thing to think about and consider when you're renewing your loan is, what is your income situation going to look like for the period that you're looking to refix for? Some things to think about are job security. Is your job secure? Are you potentially looking at changing jobs in the near future? Are you expecting any bonuses or windfalls in the future that you may want to put towards your mortgage? Talk to your broker to see if your bank allows you to make one-off payments without any penalties. Are you expecting any pay rises or pay increases in the near future? Talk to your broker to see if your bank allows you to increase your repayments without any penalties during your fixed term. Are you having a baby or going on parental leave in the near future? This may need some careful planning financially, so do let your broker know so that you can discuss your options for your mortgage. Now for the bonus tip. If you have some spare cash savings in the bank, then refix time is the best time to utilize these and reduce your mortgage balance. This can help you particularly well if you are refixing off a lower interest rate onto a higher interest rate, and potentially reduce your loan term as well, which means you'll pay less interest overall on your loan. Your lump sum payment goes 100% towards principal repayment, so it's definitely a win-win if you can manage it. So that's 5 things to consider when your mortgage is up for renewal and it's refix time. It can feel a bit overwhelming deciding what to do, so do reach out to your mortgage advisor for some assistance. If you don't have an advisor, feel free to get in touch and I can help you. If you like this video, you might like to check out my other video about whether to refix or refinance when your loan is up for renewal. This will be linked down below. Thank you so much for watching. Don't forget to like and subscribe, and I'll see you in the next one.